Again, I'm going to cover today two lectures. Lecture 11, that will be chapter 11 and chapter 8. And after this chapter, technically you're going to have enough knowledge to do your quiz, the second quiz that we have to this course. So chapter 11 is the reporting for control. Now, the reporting for control, there are two types of organizations. Technically, one is decentralized organization, the other one is centralized organization. Benefits of being decentralized organization, as you can see, is that gives the lower management kind of exposure to get experience to decision making. Also, the top management tries to concentrate on the strategy rather than on the day-to-day operations. Decision-making authorities leads to the job satisfaction. So basically, more authorities you're giving the lower management, the jobs that will be done on the very satisfied level. Lower level decision often based on the better information. So that's because the people who are working on the site, they have better information and they can make better decisions. And lower level management can respond quickly to the customers since they're the one who dealing with the day-to-day operation. Well, obviously, everything that has advantages has disadvantages as well. One will be the lower level management may make a decision without seeing the big picture, since they don't understand where the company goes and where the head office are looking at. Next one will be maybe the lack of coordination among the managers. So basically, two managers can do exactly the same work without knowing. Also, lower management objective may not be the loss of that organization, which obviously can be the problem, since the management objective is always to get a high salary by achieving the bonus, where the organization goal is somewhere else. And also, it's difficult to spread innovative ideas in the organizations, since that you have to deal with a lot of management, and those management can be a little bit unwilling to make changes in their mindset. Now, decentralization, in order to you to have a control over the in decentralized company, you have to go with the segment reporting. Segment reporting means that looking at the entire financial statement organization obviously is not going to show you which department or which area of the company is profitable or not, because you're seeing the report for the entire company. That's why you have to go to the segment reporting. Segment reporting, that's a part or only focus on the activity of the organization rather than the entire organization. So what you're going to look there, you're going to look at something that's under control of the management that you're evaluating, and you're going to look at the revenue, you're going to look at the cost, and you're going to go to the profit data. So the segment can be individual store or sales territory or sales center, service center, or can be division of the company. So the two keys to build a segment income statement. First, you have to work with the contribution format, because the contribution format is going to give you how much that particular segment, being division or product or product line, brings to the organization. And so for that reason, you have to spread the cost by fixed and variable in order to come up with a contribution margin. And second one is that you have to allocate only the traceable cost. Should be separated from the common cost. So the common cost will be the costs which are common for the entire company and not only for that particular segment. So you have to allocate only the traceable costs which are related to that particular segment in order for you to make the proper analysis. Now the traceable cost, which is the traceable cost, those are the ones that are rising because of the existence of that particular segment or that particular division. If we eliminate that division or that particular product, those traceable costs will disappear. The common costs, those are the costs which are for the operation for the entire company, like cleaning, for example. So having the separate division is not going to reduce the cleaning cost, or not going to increase the cleaning cost, or not going to make the cleaning cost disappear. So that's why those will be common costs. Same thing with the salary of the chief financial officer. Chief financial officer having 5 divisions or having 4 divisions, always going to be there. So eliminating one division, it's not going to help you to eliminate the cost of the chief financial officer. Though that's why the salary of the chief financial officer also will be common cost. So the most important thing is don't allocate common cost to the segment, because it's going to make the segment look unprofitable. Let's see now one example on the activity-based costing. Why we're using activity-based costing? Because that's going to help you to identify how the costs are shared by more than one segment, and which are traceable to the individual segment. Now, in this case, let's assume that there are 3 products, 9 inches, 12 inches, and 18 inches of pipe, which share 100,000 10,000 square feet warehouse, which warehouse is leased at a price of $4 per square feet. So how are we going to allocate the 10,000 at the cost of a 40,000 for the rent to those 3 products? Well, obviously we're going to use the proportional method, which means that we're going to look at the percentage of the occupancy for any of those pipes. So in this case, the 9 inches occupy 1,000 square feet, the 12 inches 4,000 square feet, and the 18 inches 5,000 square feet. Respectively, when we're using the activity-based costing, we can go with the proportional method, and we can allocate $40,000 based on the percentage. Now, the traceable cost. One thing that you should know, that the traceable cost can become a common cost, which means that traceable cost for one segment may be common cost for another segment. An example will be the landing fee paid to land the airplane at the airport, which is traceable for the particular flight, but you cannot trace it to the first class or business class or economy class, because you're paying the landing fee for the entire airplane, regardless if you have passengers on first class or business class or economy class. You still have to pay. Now, the segment margin is measures which is computed by subtracting the traceable cost of that particular segment from the contribution margin. And that will be your best guide on the long-term profitability of the segment. Let's pretend we have a company which runs 2 divisions. One is the computer division, the one is the television division. And let's take a close look to the television division. First, we're going to have an income statement, which using the contribution margin format for the television division. And we can see that the sales of $300,000, we have a variable cost of goods sold, $120,000. Other variable cost, $30,000. So the total variable cost is $150,000. That gives us contribution margin exactly the same, $150,000. And then we have a traceable fixed cost of $90,000, and that gives a divisional margin of $60,000. Now, in this case, fixed and variable costs are listed in the separate section, as you already know, by preparation of contribution format. And the cost of goods sold, they always consist only and only variable cost. Now, let's see the company itself. The company, as we said, they have a television and computer division. So when we add those 2 divisions, we can see that the division margin for the television, 60,000, for computer, 40,000, which transfer to the company, 100,000. But there's a common cost for the entire company, and the common costs are not allocated for any of those divisions, which is $25,000. So that's for that reason, the net income of the company is not the divisional margin. It's divisional margin less common cost, which are common for the entire company. Now, fixed costs, which are traceable for one segment, can become common cost if the company divides into smaller segments. So let's see how this is going to work. Let's take a look now. We already know the television division and what's the television division sits. So we know that in the television division, we have a traceable fixed cost of 90,000. But now if you make a separation of the television division between the two divisions, regular and the big screen, obviously the total cost for that division will be 90,000. But let's see how this cost is going to be related to the regular and the big screen. So in this case, we can see that the regular have a sales of 200,000, big screen 200,000. That gives you exactly the same, 300,000. Now the variable cost will be exactly the same. So the variable cost will be 95 plus 55, and that's going to give you a number of 120. So the contribution margin of this division is 150,000, which is exactly correct, 150. Now, the question is, what's happened with the traceable cost? Traceable cost, we can trace them 45 and 35, that's total 80,000 to the regular and the big screen. But hold on a second, our traceable cost for the television division was 90,000. Now, when we divided that television division into regular and bigs, we can trace to the regular and big only 80,000. The $10,000 that left, that will be the common cost for the television division. Basically, there will be a manager or some costs related only for the television division, regardless if you're doing the regular or big screen. So eliminating one of those, regular or the big screen, it's not going to change the common cost. The common cost is always going to stay there. On the segment reporting in International Financial Reporting Standards, that dealing with the International Financial Reporting Standard 8, for those of you who are going to continue with accounting, they learn more about it. Require that the segment reporting to be prepared for the external user use the same method of definition used for the internal segment. So as we already know, and as we're going to see in accounting, there's a different ideas there, but that will be only for those of you who are going to continue with accounting. Now, omission or disregarding some of the cost in the segment of some cost in the segment process is one of the problems with the proper costing for the segment. Also, assignment of the segment cost will cause that a really common cost to the entire organization can be another problem. So that's why you're not allocating common cost to the small segment. And use of the inappropriate method for allocating cost among the segments is also another problem. Now, what's going to happen and what is the value chain in the organization? The value chain of the organization and the cost assigned to the will be the cost attributable to the segment for the company for the entire value chain. So we're going to start with the research and development, product management, manufacturing, marketing division, distribution and service, customer service. Then that will be the entire value chain. Why it's called value chain? Because we bring the value to something and transfer to the product and bring it to the hands of the customers and provide our customer service. Now, the cost of the value chain will be a cost for every single of those elements. Now, the inappropriate method to allocating the cost is that many companies do not correctly handle the traceable fixed expenses to the segment income statement. First, they may not trace the fixed expenses to the segment, even when they're feasible to do. Second, they can inappropriately allocate use inappropriate allocation based to allocate the traceable expenses to the segment. We're going to see examples, but let's finish this. Now, the common cost. Now, the common cost, remember this, common cost should not be arbitrarily allocated to the segment based on the rationale that the sum has to cover the common cost. And there are two reasons for that. First, this practice makes a profitable business segment appear to be unprofitable, and allocating common fixed costs force management to make the wrong decisions and held accountable for costs that they cannot control. Again, don't make people accountable for things that they cannot control. Let's do one quick check. This company has the two divisions. One is the bar, the other is the restaurant. For the entire company, the segment margin is $244,000, which comes $40,000 from the bar and $230,000 from the restaurant. Common costs are $200,000. Again, don't forget, common costs cannot be allocated to any of those because it's not those are common costs. First question: how much of the common cost can be avoided by eliminating the bar? The question is, if we decide to stop, bar disappears, how much of those $200,000 we can avoid? What do you think? Any guests? Are you guys there?
Technically, none of it.
None of it. And that would be the correct answer, because those are common costs. Yes, and that's correct. The common costs cannot be eliminated by dropping a segment. So now let's see. Suppose that the square feet is used on the basis of allocating the common costs, which is the wrong thing to do, but let's pretend we're doing it. How much will be allocated if we're allocating this common cost? How much will be allocated to the bar if the bar occupies 1,000 square feet and the restaurant occupies 9,000 square feet? So how much of those 20,000 will be allocated to the bar? Obviously, you have to use the proportional method here for allocating those costs. So what will be the number that we are allocating to the bar?
It's 20,000.
20,000, and that will be correct. Why? Because 1,000 is 10% of the 10,000.
Yeah.
10% times 200, it will be 20,000. Okay, so if we do that, if this company allocates the common cost to the bar and the restaurant, let's see what's going to happen. If we decide to split those common costs, right, to allocate them to the bar and the restaurant, suddenly the bar appears to be unprofitable. So technically, shows this chart here, on this report here, shows that we're losing money on the bar. So pretend you're the manager who don't understand that the common cost cannot be avoided and shouldn't be allocated. And then you're going to say, oh, I'm losing money on the bar, so I should eliminate the bar. So the question is, should the bar be eliminated?
No, because even if you eliminated the common cost, it will be the same.
Exactly. So even if I eliminate the bar, I'm not going to change. I'm not going to avoid the $20,000. The $20,000 still going to stay. So let's pretend we eliminate the bar completely. Currently, with the bar, our profit is 44,000. Let's pretend we're eliminating the bar, and as we said, the common cost will stay. How much will be our profit now, having only the restaurants, and knowing that the restaurants contribute $230,000, and we have 200,000 common cost? What will be our profit, having only a restaurant? Here, if we eliminate the bar, currently we're making $44,000. Let's eliminate the bar. We say common cost is going to stay. So now we have only restaurant. Only restaurant stays. How much will be our profit only with the restaurant? Obviously, those 200,000 is going to transfer here 200,000, and our profit will be how much?
Yeah, just 30.
30,000. So where we are better, with the bar or without the bar? When we're making more money? Obviously, we're making more money having a bar, right? When we're having bar, we're making 44,000. If we don't have the bar, we're going to make only 30,000. Make sense? So in this case, should the bar be eliminated? Obviously, no. Why? Because profit right now is 44. If you eliminate the bar, we're going to make only 30,000. That brings us to responsibility center, because we usually always like to keep somebody responsible. And the responsibility centers is the broadly defined as any part of the organization where the management has a control. There are three primary types of responsibility centers, and those are cost center, profit center, investment center. There's another one, sales center, which is not mentioned here. Now, organization can categorize responsibility center into one of those three types of, or four types of business for the cost, revenue, investment funds. Let's see. First, let's talk about the sales center. Sales center, which is not here. Sales center is dealing only and only with sales. Now we're dealing with the cost center. Cost center is the segment where the manager can have control only and only the cost, not over the revenue, not over the investment. Profit center, well, profit comes from the revenue, from sales less the cost. In that case, most likely profit center manager of the profit center will have allocation, will have control over the revenue and the cost, but not for the investment. And the investment center will be the highest center of all centers, and that will be allocated somewhere in the head office of the company, where somebody collect all the profits from all the centers, and now he's responsible for the investments of that idle cash that they have. So investment centers, again, will be in this company. Investment centers will be on a very high level, which will be the CFO or the president or the vice president. Profit center will be different divisions, and the cost centers will be production. How are we going to measure this? First will be return on investment. What's the return on investment? The return on investment is how much you making from the money that you invested. Obviously, the money that you invested will be transferred to the operating assets, which will include cash, accounts receivable, inventory, plant, equipment, and any other product asset, which will be your assets in the company. And the income will be measured before interest and before taxes. So the question is, simple question. If you have $1,000, you invested in short-term saving account, let's say for 1 year, and that account at the end of the year, you invested 1,000. At the end of the year, you have $1,100. So your income from that $1,000 is $100. How much is your return on investment in percentage? Any guesses? Again, the question is, if you invest $1,000 in the short term, 1 year saving, and at the end of the year, that saving generates $100, how much is your return on investment? As a percentage. Do you understand the question? Or you're trying to say something on the chat room? Can you say something? No, you don't say anything in the chat. Can you guys hear me?
Yes, can
Yeah,
you repeat the question, please?
The question is, you're investing $1,000 for 1 year on the saving account. At the end of the year, that $1,000 bring you $100. So at the end of the year, you withdraw $1,100. How much is your return on investment?
10%.
10%.
10%. How did you get it?
Taking
The
1,000
income that
over
you receive,
100.
right? The income that you get over the original investment, correct?
Yeah.
Same idea with any organization. So what you're going to get the operating income or income divided by the assets, or the assets will be the investment that you make. So, which are argument of using of the net book value. So now the question is, since we're dealing with the, you can see here, we're dealing with the plant and equipment. The question is, which amount we should use it? Should we using the net book value or to measure the operating assets? Which one? If we're using the net book value, that will be consistent with how the plant and equipment are reported in the balance sheet. So basically, will be original cost less the depreciation. And the calculation of the operating income, which include the depreciation as an operating expense. So that will be more consistent. The other thing, the other opponents of this calculation is that we should use the gross cost method, because the gross method eliminates both age of the equipment and the method of depreciation, and also does not discourage the replacement of the old equipment. Anyhow, let's do the calculation. Most companies using the net book value, which will be the original cost less accumulated depreciation, come up with the net book value. So in order to understand this, we have to understand that return on investment is equal to the operating income divided by the average operating assets. Now, in this case, if I do time sales divided by sales and split the formula, I'm going to get margin, which will be operating income divided by sales, and I can get the turnover, which is sales divided by the average operating income. Because of that splitting, doing here times sales divided by sales, then I'm going to have a new formula for return on investment, which will be equal to the margin time turnover. But the margin again is operating income divided by sales, which is the margin of the company. And sales divided by the average operating assets will be the turnover. So there are three ways to increase the return on investment. First, to increase the sales. Obviously, you can see here, we have how many components we have here on the return on investment. Here we have only two, but since we split the formula doing sales times sales, same as sales divided by sales, now we have three things. We have operating income, we have sales, and we have average operating assets. So the three ways to increase the return on investment is to, if we increase the sales. Since the sales working here as a nominator, turnover, increasing the turnover, it's going to increase the return on investment. Next thing is to reduce the operating expenses. What's going to happen if we reduce the operating expenses? If we reduce the operating expenses, operating income is going to go up. When the operating income goes up, that's a nominator, it's going to increase the margin. When the margin goes up, return on investment goes up. And the last option is to reduce the operating assets. Why? Because the operating assets are our denominator in the turnover formula. By reducing the denominator, we're going to increase the result. Increasing the turnover is going to increase our return on investment. In order you to understand this, you have to understand the formula, and you have to understand what is included in every those three elements. First, return on investment, we can get it the margin time turnover. But margin is calculated by operating income divided by sales. But operating income comes from sales minus the operating expenses. So if we increase the sales, we increase the operating income. That increased the return on investment. If we decrease the expenses, that increased the operating income and increase the return on investment. From where this, so how are we going to affect the expenses? Well, the expenses, we have to know from where the expenses come from. And those will be cost of goods sold, selling expenses, administrative expenses. So if we decrease any of those expenses, we're going to decrease the operating expenses, which is going to increase the operating income, which is going to increase the margin and going to increase the return on investment. On the other side, we're working here with the average operating assets. But here on the average operating assets, we have current assets and non-current assets. So if we hold less cash, if we reduce the accounts receivables, if we reduce our inventory, then that will decrease the average operating assets, current assets and respectively average operating assets. If we decrease the current assets or average operating assets, that's going to increase our turnover, which is going to transfer to increase in return on investment. So that means more cash will be available or will be given to the people. The other thing is that you have to understand the average operating assets come from the non-current assets as well. In the non-current assets, you have the plant and equipment and the other assets. Other assets will be investment in the other companies. That will also be considered a non-current asset. So reducing those one also is going to increase the turnover or is going to increase the return on investment. Let's work with the formula and see how this works. So first, this company reports the following. They have operating income 30,000. Average operating asset 200. Sales 500. Operating expenses 47. Obviously, sales minus the operating expenses is going to give you the operating income, which is 500 minus 470, 30,000. The next thing that we need, average operating assets is 200. So what we're going to do, operating income goes here. 30,000 divided by sales, 500,000. And then we're going to have sales, 500,000 divided by the average operating assets, which is 200,000. And we're going to get the numbers. Let's see how those numbers come. 30 divided by 500 is going to give you 6%. Margin is 6%. And turnover is 2.5. So for the investment that you made of 200,000, you get that investment 2.5 times. So your return on investment is, in this case, is 15%. So let's see how we're going to affect this 15%. This is the basic 15%. Sorry, here we have a basic 15%. How are we going to affect this? First, you said if we increase the sales, without an increase of the operating asset. So let's say the sales, increase the sales to 600,000. Once we increase the sales, obviously the operating expenses also is going to increase because we have cost of goods sold, which are related to the sales. But now we're generating more income. Our income jumped from 30,000, jumped to, sorry, where was that? To 42,000. And there's no change in the operating assets. The operating asset stays the same, 200,000. So let's see where we are at this point. 42,000 divided by 600 because the new sales are 600. So now we increase the margin. We increase the margin from 6% to 8%. Was it this formula? No, sorry, 7%. And then the next thing that we did is the turnover. Since we increased the sales to 600, we increased the turnover from 2.5 to 3. So our return on investment increased from 15% to 21% by just increasing the sales. Next example will be, let's decrease the operating expenses without changing the sales and operating assets. So basically, they were able to reduce the operating expenses by $10,000 without effect on the sales. So the sales still 500,000, operating expenses goes down 460, which transfer to the higher operating income. Well, in this case, operating income is in the margin. And since everything else stays the same, right? Then what we're going to see? We're going to see change in the margin, but no change in the turnover. So let's see. So again, margin is going to change from 6% to 8%. No change in turnover because we're not changing the sales. Sales stays the same, and average operating assets stays the same, 200,000. So that's transferred to return on investment of 20%. So basically, we increase the return on investment from 15% to 20%. Now, next thing, let's decrease the operating asset with no change in the sales and operating expense. So basically, our operating income is going to stay the same. We're only going to change the average operating assets. So what will be the difference here? There will be no change in the margin. The only thing that we're going to change is that since we're decreasing the average operating assets, there will be change in the turnover. So let's see how this is going to work. Again, margin stays the same, 6% here, 6% here. However, the turnover now is 2.78. Why? Because our assets went down with 20,000. Where here, our turnover is 2.5. And increase in the turnover give an increase of 1.7% in the return on investment. There's another thing. Now let's play with the old numbers. First, let's assume that the manager invests 30,000 in piece of equipment. That increased the sales by 35 and increased the operating expense by 15. So now we have change in the all three. We have change in the investment. Average investment now goes to 230. We have change in sales by 35. And we have increase in operating expenses to 250. So we affect the operating income. So what's happened in this case? We increased our return on investment from 15% to 21.8, which is positive for the company. Which are the critics against everything? There's opponent and there's people which are against. Which are the criticism against return on investment? Well, in the absence of the balance scorecard, management may not know how to increase return on investment. So basically, what they're saying is if you don't have this chart, management may not know how to increase the return on investment. And we're going to see later what the balance scorecard also means. Also, management often get the current situation, so they don't have control over the committed cost, which committed cost are the expenses. And management evaluated on the return on investment, they can reject the projects which are profitable for the company. So that's why we have a new measure rather than return on investment. And the new measure is residual income. Let me stop the recording at this point.